Be honest. You've pulled up your portfolio at night and stared at Nvidia's stock price wondering, should I be buying this dip? Or is there something everyone else knows that I don't? Everyone around you is saying Nvidia is a lock, AI isn't slowing down. But something still feels off. The news says the company lost over $1 trillion in market cap in about 2 months. Then some analyst comes on TV and says buy more. So who do you actually trust? Here's the part that should really bother you. Back in 2000, right before the dot-com crash, there was a company almost nobody worried about either. Cisco. Everyone said the internet needed routers. Cisco made routers, so Cisco was unkillable. 18 months later, Cisco had lost close to 90% of its value. Not because the internet stopped mattering, it didn't. It's still the backbone of everything we do today. But because the money underneath the story wasn't as solid as everyone assumed. I'm not saying Nvidia is Cisco. I'm saying pay attention when I tell you this, because the specific thing I'm about to show you is eerily close to what actually broke that story apart. Let me give you the conclusion up front. The real story here isn't the stock price drop itself. It's this. Nvidia is lending money to its own customer, and that customer is turning around and using that money to buy Nvidia's own product. Wall Street calls this a circular deal, and the bond market, well, the part of the financial system that almost never panics for no reason, has already started reacting to the smell of it. Why does this video matter to you? If you understand this circular financing structure now, you'll be positioned to move before the crowd when the market shakes. If you don't, you'll end up reacting to headlines, buying at the top, selling in a panic at the bottom, exactly like the people who held Cisco all the way down because the internet is the future was technically true the entire time. I'm Moon. I obsess over one thing, where money actually comes from and where it actually goes. If you're holding Nvidia or other AI names right now and that nagging feeling of, should I really keep holding this, is keeping you up at night, hit subscribe, and if this video helps, drop a like. Let's get into it. Here's the common belief. Nvidia is just a great chip company that makes great chips and sells a lot of them. That's true, but here's what people are missing. A meaningful chunk of Nvidia's revenue is now coming from companies that Nvidia itself has invested in. Think about it simply. I lend you money, and you use that money to buy my product. My revenue goes up, right? But is that real demand? Or an illusion I created myself? That's exactly what's happening between Nvidia and OpenAI right now. Here's the play-by-play. Last September, Nvidia agreed to invest up to $100 billion into OpenAI, close to 150 trillion won. In return, OpenAI committed to buying millions of Nvidia GPU chips, so it doesn't stop there. More recently, reports surfaced that Nvidia is discussing putting an additional $250 billion into OpenAI. The day that news broke, Nvidia's stock dropped nearly 5% in a single day and lost its spot as the world's most valuable company to Apple. Trace the money and it looks like this. Nvidia invests into OpenAI, OpenAI uses that cash to buy Nvidia chips, and the purchase shows up on Nvidia's books as revenue. The money makes a full loop and lands right back where it started. That's what we mean by round tripping. Here's an analogy that makes this click. Imagine you own a car dealership and business is starting to slow down. So you start handing out loans to your own customers, but the loan only exists to buy a car from you. Every loan you hand out shows up next quarter as a sale. Your revenue chart looks fantastic, but your showroom looks busy. But you haven't actually found a single new customer who wanted a car and paid for it with their own money. You've just been paying yourself, one loop at a time, and calling it growth. And this isn't even a new trick. It's almost the exact playbook that quietly wrecked the telecom industry in 2000 and 2001. Companies like Lucent and Nortel handed billions in financing to smaller telecom startups, on the condition those startups bought Lucent and Nortel's networking equipment with it. For a while, it worked beautifully. Revenue kept climbing. Everyone kept cheering. Then, the moment those small telecom startups couldn't pay the money back, the entire chain collapsed within about a year. Lucent's stock fell more than 95% from its peak. Let's do the math on OpenAI specifically. OpenAI reported around $4 billion in revenue in 2024 against roughly $9 billion in operating costs. That's with a 75% discount on cloud computing from Microsoft. Estimates suggest that at market rate cloud pricing, that bill would run about $20 billion a year. A company burning through 5 times its revenue and costs is about to receive an additional $375 billion in backing. Does that sound like a business standing on solid ground? Or does that sound like a company that needs the story to keep working no matter what? Here's where it gets genuinely interesting. The first people to notice something was off weren't retail investors, it was the bond market. According to the Financial Times, credit default swap prices, essentially insurance against a company defaulting, on Nvidia, Alphabet, Amazon, and Broadcom have spiked sharply in recent weeks. When that insurance suddenly gets more expensive, it means the big money managing credit risk is pricing in a higher chance these companies could run into trouble. Stock market sentiment is still largely AI keeps going up. But the bond market is already sounding the alarm. That gap between the two, that's the thing worth watching closely. Jim Cramer on CNBC put his finger on exactly this. If OpenAI can eventually go public and use that IPO cash to pay back what it's borrowed, this all works out fine. But if it can't, he said, it's a completely different story. In other words, this entire structure is leaning on one unproven story that OpenAI will go public someday and make a fortune. Here's what most people don't realize. This pattern isn't new. At the peak of the dot-com bubble in March 2000, the NASDAQ 100's forward price-to-earnings ratio hit 60 times. AI stocks today are sitting near similarly historic highs. Palantir is trading at nearly 69 times sales, Nvidia over 40 times. Anything above 30 times is typically considered overvalued. And just like back then, money is piling into a small handful of giant tech names. In 2023, 7 companies, Apple, Nvidia, Tesla, Alphabet, Meta, Amazon, and Microsoft, accounted for 71% of the entire S&P 500's returns. And roughly 70% of venture capital funding went into AI companies in early 2025. Compare that to the dot-com era, when 80% of VC money flowed into internet companies. The parallel is honestly a little chilling. Let's talk psychology for a second. Why do people keep buying even when the numbers look this stretched? It's simple. The fear of being left behind, combined with the assumption that it's always gone up, so it always will. That's not logic. That's habit. The same psychology was in the room right before the dot-com crash and right before 2008. Nobody standing inside a bubble ever believes they're inside one. That's the whole trick of a bubble. It only ever looks obvious afterward. I know what you're thinking right now, but Nvidia is actually profitable. That's different from the dot-com companies, isn't it? You're right, that part is genuinely different. Nvidia has real earnings, but the issue isn't whether the earnings are real, it's the quality of those earnings when a portion of them is money that Nvidia itself put into the system in the first place. That's a distinction worth holding on to. This isn't about fake profits. It's about how clean those profits actually are. Now let's get practical. To be clear, this isn't a buy or sell call. This is my personal read on the situation, nothing more. First, watch how the market reacts every time new circular financing news drops. If the stock falls on days when more OpenAI investment is announced, that tells you the market is growing uncomfortable with this structure. Second, keep an eye on credit default swap spreads. It's not something most retail investors track in real time, but when headlines about it appear, don't scroll past them. The bond market usually moves before the stock market does. Third, think about diversification within the AI value chain itself. There are signs the center of gravity is shifting from GPUs alone toward memory and storage, HBM chips specifically. That's part of why names like Micron keep coming up in this conversation. Fourth, watch whether and how OpenAI actually goes public and at what valuation. That's the last piece of this entire puzzle. If that IPO falls short of what the market is pricing in, it could be the first domino. You might be thinking, this circular financing concern has been floating around for months. This isn't new. And you're right, the concept isn't new. What is new is that this concern has moved beyond stock market chatter and started showing up in actual bond prices. It's the difference between worry that's just talk and worry that's now backed by real money moving. That shift matters a lot. Here's the bottom line. Nvidia's stock isn't wobbling because of some ordinary correction. It's wobbling because money is looping between Nvidia and OpenAI and landing right back where it started, and the bond market has started to question that loop. That's the sharpest edge of the entire AI bubble debate right now. Go back to that dealership I described a minute ago. The lights are on. The showroom looks packed. The revenue chart keeps climbing. The only question that actually matters is the one nobody in the room wants to ask out loud. When the loans stop, does anyone still walk through that door? Markets always move on stories. The people who survive are the ones who can tell which stories are real and which ones aren't, and which ones just look real because the lights are still on. I hope this gave you a little more clarity on that. If it helped, hit like. And if you want more of this kind of money flow analysis, subscribe. Protect and grow what you've built.